I think the reason it triggered a reaction is because they kept saying they won't negotiate at all as long as the strait is still closed. And so the fact that they sent anything while the strait is still closed was considered a positive in the market. Maybe. You would like to think so. The VIX is climbing, but for our swag levels, we would need to get back above this red box that I've got up here. This it's like 1740-ish. So as long as we're underneath that, then we're still okay. The lower the VIX, the better for the markets. So yeah, we're rising and the markets are falling, but we're still within the day's range. And if you look at things like the weighted the weighted AD, we're not down much. Earlier, we wasn't up much. The ticks are just hovering between plus and -5. There's just nothing here. Yeah, we're getting a little extended from that 10-week. Not enough to matter. I mean, we're not in extremes, but we are getting to the point where we need to watch how much farther we can go. I said this morning I think we could go up a total of 1.25 today before we would start to see too much is too much. We're not there yet. We're only up not even a half of a percent. So still coming in a little light. I got a scammer reached out the other day and said, here's a traffic ticket. You got to click this link and set up a court date, or we're gonna issue a warrant for your arrest." Dumbass. I know it. So I just posted in the chat cycle phases: early recovery, mid expansion, late expansion, and recession cycles. And then your typical leading and lagging sectors depending on what cycle phase we're in. Different analysts will argue when we're transitioning out of one into another. Um, but sector rotation is something that I see people really fight with. And this is supposed to help give some ideas into trying to spot or identify what we have. And if things are to change, then where would we go? What would we rotate out of? And what would we rotate into? So these do change over time. One thing that we've recently seen change is utilities. Utilities is now more directly tied to AI, energy, and data centers. So it doesn't really fit into the recession category the way it used to. And I don't have an answer for that either, by the way. I'm still at a loss to figure out what we're going to do. I don't know. But um, growth and value play into that really well. If you're looking at sector rotation, if we're in a growth phase, then you got your Mag sevens and technology, consumer discretionary, financials. Those tend to do well. And if we're not going to be in those anymore, then we would go into the other stuff: utilities, staples, energy, real estate. But again, utilities and energy, that's data now. So you don't that doesn't really fit, but staples do. And real estate, um, it's something to focus on. Industrials, as long as you're not focused on like rare earth kind of stuff. So there's hot spots in there you have to be kind of mindful of. Flight to safety, risk on, risk off, risky sectors, sectors that we expect to do better when people are in a flight to safety. So just thought I would share that, give you the idea that, it's something that we can all focus on to help us better swing trade. Not the kind of swing trading where you're going to be out by next Friday, but more of a longer term idea of focusing on what kind of market do we have right now, and is it changing? Is it transitioning? And if it is, well, what is it transitioning into? Where should I be shopping around for ideas? We're at all-time highs, right? And we got there because of growth. And generally speaking, when the markets are going up, it's because of growth. It's not value stocks anymore, and it hasn't been for decades. So um, you could say that growth markets are bullish markets. That's not necessarily true. So I don't like saying it that way. But if the broader market, NASDAQ, the Qs, the Dow, the Russell, sometimes the Russell, if everything is doing good, you're in a growth market. You should be looking at names that fit into the growth space. What's handy about that is there's a lot of ETFs, ETNs, all these baskets of stocks. You can literally just go find the ETF that is called the S&P Growth ETF or the S&P Value ETF and look at which one is performing better, which one is going up, how much has it been going up over the last few days, how's it doing in the last month. You know what I mean? You don't have to figure it out on your own. There's a lot of tools that are already out there that help you figure it out. And I encourage people to think that way, right? When I started, I'm kind of a smart guy. I don't know it all, and I make some I make some really stupid mistakes sometimes, but I consider myself pretty smart. And I found that I was doing a lot of legwork because I'm smart enough to do it, but I was too stupid to ask if anybody else had done it before me. And sure enough, when I finally had that epiphany, I looked around and realized the work had already been done before. I wasn't the first smart person that had come along. There was plenty of others before me. So before you go working through a whole bunch of work, just look around and see if it's already been done before. It'll save you a lot of effort. To be fair, I did learn a lot in the journey, so it wasn't a complete waste. But, you know, the family would like to see me every once in a while, getting out of the office and participating, maybe see some friends from time to time. So it wasn't a complete waste, but just remember you don't have to do all the work yourself. There's ETFs, ETNs that can make that a lot easier. I'm looking at my morning list because I know I have growth and value ETFs in here. They don't really move that much in the pre market, but sometimes they do. And then that, of course, gets my attention. So here's SPYG. That's the growth one. And we can see that it's up this morning around 0.75%. And over a 5-day period, it's basically flat. Well, that's not helpful. So maybe we'll find the value one. If this is green, then the other one's probably red. So now I'll just sort them by what's green and what's red and see if we can spy the SPY value one. Nope. It's also green, just not very much. Over a 5-day period, it's up 1.75%. It's kind of flat today. And oh boy, there goes our weighted AD. There goes the market. Get it, get it. Get you some. Uh, let's go back to the RTH open and then test the RTH low of day. If we can get underneath that, we can test the Globex low, and then it's game on to the downside. We can really get after it. I don't expect that we're going to do that. SPYV. There's our value for the S&P 500. And it looks pretty good. Value has been doing good. Now, keep in mind, and this can be a little confusing, it's not an either or proposition, right? You can have growth doing well, and you can have value doing well, right? It's not a game of winners and losers. So if they're both doing well, which one's doing better? And that's when we can compare them to each other by using ratio charts. If you're new to trading, don't be intimidated by this. You got a couple of ways to do it. Math helps if you're a bit of a math nerd, but you can use a minus sign. So then you can take something and subtract it from something else. Thinkorswim allows you to do this. So does TradingView. I'm going to put growth first and subtract value. So SPYG, SPYV with a minus sign. And now I've divided, I've subtracted one from the other. And if we're going up, then growth is outperforming. If we're going down, then value is outperforming. The other way you can do this, and it's better on TradingView, is to use the actual ratio. So SPY divided by SPYV. We want growth versus value with a division sign. I was about to say I'll probably get an error, and if I do, there's a ratio tool on Thinkorswim. Just type in ratio. And there's two of them. You have a pair ratio and a price ratio. I want the price ratio. I think it's less confusing to use this one. So we just put in SPYG on top and SPYV on bottom. It'll make the ratio for us and not the one that is using the subtraction either. It will allow me to add some moving averages if I want to. So, why not? We'll put in a 10 and a 50. And of course, if we're doing moving averages, I want my colors. So 10 and 50. And for the ratio, I don't like a multiple colored ratio. Just I can understand slope and direction. You know what I mean? Like, thank you. It's going up. I think I know what that means. So I don't need it to be turned green just because it's going up. I figured it out. So this is the ratio. I like that better. We know that it's a different number than what I used over here because when I subtracted the two from each other, I've got 53.27. When I used a ratio, I got 1.70. So we know that we're looking at two different things. I don't need SPY on top here, so we can just get rid of that. And now we've got these two. Growth has been underperforming and now is trying to get back in the game. And we can see that, right? Growth versus value here. Yeah, no. Thinkorswim with its infinite wisdom and indicators, it didn't keep what I typed. Let's try it again. Hey, there we go. That looks better. There's our March reversal and our run back up growth dominant. Before that, value was doing better. And that's how we got to the lows in the SPY that we got to, right? Because value was outperforming. So you can find these answers a lot of different ways. Wow, I chased everybody out, right? It's Friday and I went all nerd on them. Just you and me, buddy. Are you still here, Austin? Sorry. Sorry, I went all nerd and scared everybody away. What's the matter? What's going on? What you struggling with? That that is true. Taking care of a parent, I'm doing that as well, and I have a lot of help from my wife. A lot of help. I say I'm doing it, really, she's doing it, but it's a lot on her, and it does affect both of us. That is rough. I worked in the oil field most of my life, so I'm used to actual work, and I sit in this office and I'm not doing that, I'm just getting fatter and slower and lazier. So I started hunting around. I found various odd jobs. Like I still work here, This is me working right now. But I mean this this isn't paying anything. So this if I was living on this, I'd starve to death. But I've got work with different funds. I do research. I got my little coaching thing on the side. I've found a lot of things that can make me money, and it's kind of nice because it keeps me engaged hunting around for alternative sources of income. But I'll tell you, I miss my job, like an actual job where I had a 401k and really awesome insurance that I didn't have to pay a fortune for. But I like my life, and I got all my family saying, "You're like inches away from your doctorate. Why don't you just get your doctorate and go be a doctor?" People suck. There's That's short and sweet, simple, easy. People suck. I don't want to go be a doctor because I don't want to go deal with people. I just hang out in my office and avoid everybody and not go be a doctor. On the trading side, we're in the worst trading environment I've seen in the whole time that I've been trading. It's never been this bad because we don't have any of the guidance that we normally have for the swing trades that everybody would like to see. I mean, S&P at all-time highs, the rule is get long. And if you do that, then you're great, but there's no trust right now to do that because all of our tools are saying don't do it. We got so many bricks in the wall of worry. This thing's about to go down in a heartbeat every single day. You got another headline and warning saying, we we're over allocated. We have no trust. We're going to war. We got no energy. Costs are rising. Everything's bad. Don't get long. But long is the answer because we're at all-time highs. So if you're going to swing trade, stick with the ETFs and stick with the indices. As long as they're riding above the 10 and the 20 and all the moving averages are angled to the upside, stay long in the indices. When the ETFs get above their 10 and the 20, it's time to get long in those too. That just keeps your money working for you, right? That's the money that you don't really mess with. You leave them alone unless they begin to break down. And then, of course, you can take it out because you don't want to hold for 30 years and then you go to use it and it drops below all the averages and then you're down, right? You don't want that kind of trash. So we hold it while everything's good and then ditch it when it crosses the 20 and start all over, rinse and repeat. The more individual swing trades, stock pickers plays, we're in a really divergent market. That's supposed to work well, but everything whiplashes. We're going from growth to value to growth to value to growth to value so fast that by the time a theme is recognized, it's already rotating out again. So that's not really helpful either. That leads us into day trading. Thank goodness for day trading, or I would starve. Is the ability to day trade in the futures. We've never had this in the history of the world. We've never had access to a day traders market like we do now with the the MES. I opened that new account and it has a daily goal right now of like $50, and that's because I maybe traded an hour a day, maybe. And $50 is nothing, you know, for the MES, the MNQ, $50. That's easy. You know, it's a good way to grow an account. It's not an overly large goal, and if it's a trash day, then just don't do it. It's not like you have to go get that $50 a day, but if you got a decent market, turn on a day trade account, grab your $50, and then leave it alone again. Swap to paper, find something else to trade, do something. And that's $50 after your bills. So if you're paying $16 for data, divide that by 20 days. That's how much money you need for that. The commissions, the fees, everything. Grow that account by $50 a day and just keep growing it until it's big enough that you're ready to make it $100 a day. And you just do that by adding a contract, not by holding longer or trying to get bigger trades in price moves. You get the same moves, the same setup, the same play. You're just doing it with two contracts instead of one. Make $100 a day instead of 50. When you're comfortable and the time is right, add another contract. Just keep doing it. If you can't do the, do you day trade? You The thing about day trading is having the ability to trade with leverage, right? So options give you that. The problem is options were never designed to be day traded. We do it. When it comes to day trading and options, it's not one size fits all. Some days we can sell to open and just run, short verticals. Some days we want to buy to open and just, buy a call and then close it to get out, or buy a put and close it to get out. I've seen a lot of people think that they can just 0-day trade and run the sell side every day just because the market's open and there is a 0-day to trade. So I'm going to 0-day trade and I'm going to sell a call today and sell a put tomorrow and sell a call tomorrow. And that doesn't work. So when you're going to day trade and you're going to use options, you have to figure out, is this a day that I should be buying them, or is this a day where I should be selling them? And then even with that, what kind of buying are we doing? Near the money, on the money, in the money, and or what are we selling? Same answer too. At the money and or near the money or in the money. Because depending on the strategy or depending on what you're trying to run, you want to adapt the trade to fit the scenario. Today's a range day. I don't really like to do the sell side on range days. Iron condors are fine. You're just not getting very much money, and a range day can break at any point and become an expansion day, especially with a president that can tweet. So I know a lot of people say, "Oh, well, if it's a range day, let's just do iron condors." Yeah, no, thanks. I'd rather not. But if it's a day where we woke up and hauled ass all morning long, down, up, I don't care. If we went somewhere all morning, I am much more interested in selling something. Here's a Friday where we ran pretty much until 1 o'clock and then we flipped over. This had expanded far enough and we had ran through some key levels. If I turned the ADR on, we had probably smacked into that, and it finally gave up. And that was a good time in the afternoon to sell some calls. I don't trade 0 days with options in the morning. You can. I don't, because I don't trade the first 30 minutes. So that makes it until 10 at least. And then I want to be out of those by 11:15 or 11:30 at least. So it doesn't give me very long on the morning side to trade the options. If I'm going to trade those options, I'd really, really just rather wait until after 12 o'clock, 12:30 maybe. So after 12:30 or so, I'm hunting around for a situation just like this. I like that setup. We've gone quite a ways. The further, the better. If we're up 1% or down 1% on the day, I really like that. The farther, the better. This went 1.5% from the previous day's close. That's perfect. It really ran. It was hitting some key levels, big options levels, 7150. There might have been a call wall there, something like that, high gamma level, whatever. And it's finally done. And we're looking for some reversal signals, sell some calls up there. At the money, preferably, maybe even Jeremy style, and a little bit in the money so that I can get half the width. I'm risking 1-to-1 here, or a little less than 1-to-1. And if I'm wrong, I'll know because it'll break high a day and it'll start going up even more, and I'll close my trade for a small loss. Small in the S&P means probably 30%, at worst 40% of the total trade. I don't like it, but I mean, at least it's not 100% loss, right? So buy that back and see if it's going to make one more high and then fall, or just call it quits because it's not going to do what we thought it was going to do. But the same setup, this same run, gives you a different trade that you can do. Selling the calls says, I think you're done going up. Okay. You know what I mean? Like that's fine. I think you're done going up. But what if we think it's actually going to go down? Well, buy some puts. The ones that we would want to buy are dependent on, well, how far do we think it's going to go? Back to the open? Well, I can buy some puts at that level. Back to yesterday's close? Okay, I can buy some puts at that level. Or I can just buy some puts at the money using a vertical, one leg in, one leg out of the money, pay half the width. And again, I'm in a 1-to-1 trade again. So I can keep the risk pretty small if I really think we're going to move to the other direction. Just in this case, buy puts. I don't know the kind of day trading that you've been doing, but one size doesn't fit all. And recognizing that we shouldn't do it every day just because we can helps. It helps a lot. When I got rid of that mindset, things really changed for me. And swapping out the kind of 0 day that I was going to do to match the kind of day that I have today helped quite a bit too. And that way it's not a one size fits all day every day just because the market's open. So today I'm kind of looking to see if we're going to get some breakdown this afternoon, and we're running out of time. But if we can get below our own low here and start pushing to the downside, we could actually get down to that 71.70 level by the end of the day. There's no reason to think that we're going to do that other than maybe some wild headlines or something like that. But there's this sell in May logic. It's a seasonality thing. And if you go back and look at sell in May in a mid year election cycle like we're in right now, it has a 100% hit rate. That's a very eye catching number, right? It's ear catching if you want to say it that way. 100% hit rate sell in May on on an election cycle like we're at right now. So a lot of analysts that I know are looking for the breakdown, and that makes sense too because we got the Mag 7 out of the way, and they didn't exactly eat it. Microsoft, or I mean Meta, kind of did, but that's because of their own spending. They're spending like money's free, but the rest of them didn't do that bad. So it would make sense to sell them back off again. And I don't know, we're at highs. It's a good time to sell for the bigger dogs, if that's what they're going to do. I keep asking every day, where's our high or low? Oh, we still don't have one. We're kind of due. So if we start to go down, then we could get a pullback to like 7,100, 7,000 would be nice. I still like that 6,850. The sell in May isn't supposed to be a crash and burn, so I'm not looking at like 6,500, 6,300. I'm not looking that far down. I don't even think we'll get down to this gap down here. But 7,000, 6,900, maybe if we get a little rough. Yeah, that's fine. 7,000 would be a nice Busby. Kind of like it. The weighted AD is expanding a bit more to the downside. We're still not underneath the negative 250, and we probably won't before the end of the day today. It's not going to be helpful enough. But it has been a difficult time to be a swing trader. We don't really have a lot of themes. It's all really AI and war, energy crisis. Those are the three themes that really stand out. We had the EV theme for a while, and we had drones and the SMRs and new technologies, space, pot stocks. There were so many themes, and then it all just dried up, and all we've got is AI dominance and war, and everything else just kind of faded away. What kind of 0 day trades were you doing? The buy side or the sell side? It's a good mix. credit spreads credit spreads are not lopsided loss unless you're doing the stuff that they talk about on YouTube where you sell far out of the money stuff. The stuff that I trade when I'm doing a credit spread looks like this. It's $5 wide and I'm getting almost $3 credit. Well, that's not, you know, right. But when you had said you lost a lot of your funds from credit spreads, I've heard that from a lot of people. And when I ask them what kind of credit spreads were you doing, or lower, like, yeah, those will rip you apart. Yeah, I do like butterflies. It keeps them cheap, you know. Butterflies are a good way to go. The cool thing about a butterfly is if you give it, say, 30 days, then the trade matures and you can move the legs around and make it a better trade. When I talk to people about it, they're like, I have no idea where the stock is going to be in 30 days. That's a really bad idea. Where do I even know where to put it? And I get that. But if you're bullish, put it somewhere up, you're right. Like use calls, go above, and find a spot that's got some good liquidity and build it there. Because as it matures, you'll have a trade that's doing well. Because if the stock is actually going up, the butterfly in that 30 days will start to mature. You can move the legs around. You can do a lot with that, surprisingly enough. By the end of the trade, it's not usually a butterfly anymore. You've shifted the legs and it's turned into something else. But butterflies are a good thing, short term, long term. Just most people that I know never bothered with the longer term butterfly. They just use them short term. For an account like what you're talking about, if you've got the size for it, the jade lizard's not a bad way to go. Right? Put on or the wheel. It ties right in with the wheel where you're selling puts to get stock and then you sell calls to get rid of the stock. You can add the jade lizard to that, and I think the jade lizard goes really well with the wheel. Personally, it's not a bad way to go. But futures, you know, you can do a futures account with $500, $300. Um, And usually what I tell people is if they don't know how to trade, just go to paper and figure out your broker, figure out the buttons, all of that stuff. Because you can paper trade forever and never be successful. You got to go live at some point. But when you go live, if you start with, say, $300 and things go to hell, you're going to lose probably half that. And it's 150 bucks. I've had one single trade in an options trade that lost more than 150 bucks. If if I'm trading futures and the entire account is $300, then, it gives you a chance to grow out a small amount of capital. I turned on my Tradeovate because it has the bracket orders that I think is easier to get to than trying to mess around on TradingView. A lot of times on TradingView, I just put the order on and then I add a manual stop. That way I'm not messing with brackets or anything like that. But on Tradeovate, I've got it set to where the bracket is already there. And then, of course, you get something like the NASDAQ, that booger moves. And this is paper. So if anybody's watching me, then I take a trade. I have no risk. It's paper. So tick chart, got the NASDAQ. This sucker moves because it's intraday. I tend to trade the NASDAQ in the Globex and then I trade the ES intraday. But if I was looking to participate in this and I've got my bracket going, I'm looking for the NASDAQ to give me little bit of a signal so I can hop in. Since this thing moves so much, you can capture 10, 15, 20 points fast. And if you're wrong, then you get stopped out in whatever amount you want. I think my stop is a point and a half. Yeah, I'm at 63, 64. Yeah, 6 ticks is what my stop is, and that's kind of big for the afternoon. I don't think I need 6 ticks forward. Probably be better. So if I'm wrong, this will lose 1 point. 1 point on the MNQ is $2. That's before commissions and fees, and since I'm in paper, there's no such thing. But that's what my risk is $2. I can't get a cup of coffee at McDonald's for $2. And yet this $2 of risk can make me $20 in the blink of an eye because that's how fast the Nasdaq moves. This thing is like white lightning. There's my little rip to the upside when I think it's where I want it to be. Then I can add it, and if I'm wrong, it's going to stop me out in a point. Probably jump the gun there. We need a little more rise. Yeah, it's too soon. Now I'm screwing around because I'm on paper and I want to catch this reversal, but you get the idea, right? So you can set up a strategy, set up a plan, go to paper, show that your plan is successful. You're not trying to prove that you can make money on paper. That's kind of that don't work. You're just trying to show that you've got a strategy and that you got rules for your strategy. The strategy works, and you can effectively demonstrate that strategy in paper. Once you can demonstrate it, you're ready to go live and start proving it to the world, making money, growing the account. At this point, I've covered my commissions. So if it runs up and stops me out, whatever. Right? I had to do it again. I don't have any other tools on. I don't have the news up. I got Discord, so I'm chatting with you guys, and that's it. I got the ticks. I don't even have any flow showing down here. Nothing. You've traded long enough that you've got a feel for price action. I mean, I don't know if you're an indicator guy or not, but with your experience, I would assume you probably read price pretty well. Futures are way easier to trade than options on 0 days because you don't have the Greeks. The Greeks screw your options trade so bad, especially volatility. And here, that is true. Yeah, the first Trump election, the first Trump presidency is when everything really changed. They help some days. I do 90% of all my day trading in the pre-market when I don't have any of the options data. I don't have a lot of stuff in the pre-market. And for the most part, it's just me and price. I got Bloomberg on in the pre-market because I'm listening to what happened in the overnight while I was asleep. But that's about it. And pre-market is nice because it doesn't move very fast, but it doesn't fit everybody's lifestyle. I don't trade the open. I don't really trade from 8 to 10. Oftentimes from 8 to 10:30. But there are a lot of choices when we have war, and we have this president who likes the chaos. He said that he can make the dollar dance like a yo-yo, and they have fun manipulating the dollar, the yields. There's Japan changing things. It's going to now join the rest of the world and um, try to get out of debt by spending money, as if that worked for anybody ever before. But they're joining in, so we're getting a regime change there, and it's a very difficult market to try to swing trade in. But it won't last forever. This president can't get elected again, and once he's gone, we're going to change into a different dynamic. So even if you give up for now, I wouldn't call it quits forever. Let this president get out of the way. And while he's in there, just maybe call timeout and learn more about a different kind of trade style. Like we started today with growth and value. I don't necessarily trade with a growth value mindset, but I watch the growth value dichotomy. I keep my eye on who's dominant just to kind of know where I should be hunting for trade opportunities. My swing portfolio is beta weighted. So each trade I take is me asking, do I need some long deltas or some short deltas? Am I going in to buy some puts or sell some calls? Or am I going in to buy some calls and sell some puts? Just which side do I need? That way I know, should I be looking for some long trades or some short trades? But it's not helpful in the current environment since we have so much whiplash and no dominant themes. Forward guidance from the Fed would be really helpful. If you was looking to sit out, then you could sit out and wait until we have um, a good, solid forward guidance from the Fed. These moving averages, I believe, are EMAs. No, they are SMAs. This is paper. I don't really hang out here, so I had to look. SMA 50, 220. Yep, yep. And that way, once the Fed goes into a cycle where they're like, we're gonna hike over the next five FOMC events, or we're gonna cut over the next five events, you'll have a much steadier marketplace. It's odd how everything will change, and we'll have this more consistent outlook in stocks. So wonderful time to be trading. When we don't have that one simple thing, I hate swing trading when we don't have it. So if you were to sit out, just keep your eye on the Fed and wait for them to get back into a normalization where they've given clear forward guidance that is not data dependent. Because that's what we're in right now. We're in this hurry up and wait. We'll let you know at the next one. We're probably not going to cut. We're not going to raise, but we're not 100% sure. We'll watch the data. We'll let you know. That's not what the market wants to hear. And without that forward guidance, so much stuff changes and it makes it way more difficult to swing trade. But at the end of the day, it's all about making money. And if you have a style that you already know works and it's where you made your money before, hell, there's nothing wrong with going back to that. I tried large size scalping. I got my butt handed to me. I wasn't upset by it either. It doesn't suit me, but I gave it a try and I was really frustrated because I thought, well, that looks easy. I bet I can do that. Oh, hell no, I cannot do that. I glad I did that in paper because I got completely destroyed. But it was humbling and I learned that that's just not for me. So you ventured out into something else, you tried it, it didn't work, fine. It didn't work. Go back to what you was doing that did work and then just expand on it and improve it. Get better at that. No, I'm not into value investing. I don't. Everybody that I know who says they're value investing, it seems like they're just bag holding trash, waiting for it to move. I mean, maybe I'm misreading that, but that's what it seemed like to me. Large scale scalping is where you take an overly large position for a small move in the market, right? And I mean overly large. You're grabbing 30, 40, 50 contracts of something and you're taking it for a 10, 15, 20 cent move. That is large scale scalping. What I see a lot of people do when they scalp is they're just grabbing like two contracts and they're holding it for a very small period and they hop back out and they say, "I'm scalping." Yeah, okay. I mean that's not what your average definition of a scalp is. The average definition is that you're taking an overly large position for a small move in the market. So the large scale size scalping is my way of being able to differentiate between the two. It's really just a scalp, but the muddy waters now. People scalp with two contracts. So, Doc, you're paper trading right now, then, right? And you haven't yet traded live. What are you doing to prepare for live? The thing about getting to be a profitable trader is education, right? So you can't paper trade to success and you can't mimic copy somebody else to success. You have to actually add education in there somewhere. Study a new topic, analyze price patterns, use a new indicator. Not my choice on that one, but you have to learn something new, right? Because the whole idea is trying to figure out, hey, where the hell is price going next? And we don't learn that from paper trading. We need some education that helps us better understand what is price doing right now and where would be a good place to get a trade and where do I think it's going next based on where I think a good place to get a trade would be. So yeah, that's what you want to answer when someone says, "What are you doing to get better at trading?" It's watching videos, having topics to focus on, working through educational material, growing your ability to read price action, and not paper trading. I think paper trading is really not helpful. You can do drills. Drills are really helpful, or you can run exercises if you want to call them that instead of drills. But actually sitting there and wasting hours of your day trying to trade paper to show that you can make paper money is a complete waste of time. Yeah, you want to. Yep. Talking about Trading in the Zone by Mark Douglas. I completely disagree. I completely disagree. If we give up 8 hours for sleeping, which I get like 4 hours of sleep, but whatever, give up 8 hours to sleep, 8 hours with the family, 24-hour day, we're already 16 hours down. How many hours am I going to sit in front of the computer, wasting it, looking for an opportunity to run this paper trade strategy that may or may not show up? And how many years of my life am I going to dedicate to this that I won't be able to trade, can't make money because I still haven't got a chance to run this paper strategy? Education trumps this strategy, right? When do you run the Bullinger? Because you have the ability to read price action. When do you run the supply and demand? Because you have the ability to read price action. So the strategy can come from back testing. It can come from never having played the trade at all. Never. You can back test a strategy. Yep. Yeah. SAR, SAR, SAR. Yeah. Do you know what all of those have in common? If you can read price, then you know when to use them and you know when not to. Here's a really good example. I'm a pivot point trader. I've given myself that term over the years, and I'm not talking floor pivots. I'm talking about anywhere price turned, it pivoted, and it went the other direction. Yesterday's low, today's high, something like that. And it's one of the first things that a lot of people gravitate to because it's an obvious thing, right? When we go to today's low, everybody can see it. And so the new trader says, I can do that. Sure. Yeah, just buy it when it gets to the low of the day. It's all you got to do. Bet I can do that. Yes, you can. Go for it. And they will get their ass kicked because sometimes it works and sometimes it don't. Sometimes it's really obvious before it ever gets there that you better not buy that because it's not going to work. And then other times we just don't know and you're going to let it play out. But they're going to try it and they're going to say, I'm going to do this and I'm going to be very mechanical and I'm just going to buy it every single time it gets there. Okay, that's a 50-50 coin toss and you'll win 50% of the time. As long as you can limit your risk, you can go ahead and run that 50-50. It'll work. I promise. But they can't manage the risk. So they're going to blow up. Not because the strategy didn't work, but because they don't understand all the components. They don't understand the risk part and they're just going to blow up. What's wrong with my strategy? And this is the feedback because I've been here for years. Hey, I ran that strategy and it works sometimes. And when it doesn't, I'm getting destroyed. Yeah, you're not managing your risk. No, that's not it. They tell me I need a better way to define when should I buy that low and when should I not buy that low. All right, well, I mean, you could learn price action. No. What else you got? So, dance around, try to figure out some other way to define should I buy that low today? Should I not buy that low today? So, what do we learn from that is no matter how simple or basic or complex the strategy itself, it's only a small part of the whole thing. Can you manage your risk? Do you still have other defining characteristics for when to run that strategy, when not to run that strategy? Should you even run that strategy today? Is this the kind of day for that strategy at all? Not, I have every piece showing, like the low here today. Everything I need is there. Price is at the low. I'm going to buy it. Maybe it works, maybe it don't. All the other pieces combined, which is why I've always said education is the number one thing that will help you become a successful trader. Because along the line in the education, you're going to pick up money management, risk stops, various types of order flow, what kind of day it is, what strategies that other people have already tried along the years, and reading price action. Throw that in there too. You will learn all of those components so that you're better able to trade. Now, if you want to put all the pieces of the puzzle together and do it in paper before you go live, sure, there's nothing wrong with that. And paper has value. But for every trader out there who says, I want to be a successful trader, just don't go to paper. Don't go to paper. Leave it alone because it's going to entice you. You're going to burn hours of your day waiting for this one setup right there. Maybe you get it today, maybe you don't. There went 4 hours of your life. Tell me you couldn't have done something more productive in those 4 hours. You couldn't have learned something. You couldn't have grown in some way. You didn't waste 4 hours waiting for that bounce just so you could buy it and test your paper theory out, right? Education wins hands down every single time. Spend a month putting together an educational package. Spend months on each piece that's in that package. I know it sounds daunting and it sucks. I spent months learning moving averages. And somebody had the audacity to tell me, wow, I didn't realize you were so stupid. I learned moving averages in 2 hours. Why did it take you 4 months? I guess I'm stupid. I studied VWAP for 6 months. Maybe I'm slow. But I learned every single thing that I could learn about it. The math behind it, the formula, the back test. I went back in time and applied it to different markets, different days, short days, holidays, starting the VWAP at midnight versus starting it at 6 p.m. versus starting it at 9:30 in the morning. I studied that thing with different expansions to the VWAP, right? It's got bands on it. There's so many things that you can study, including price, but just so many things that you can add more education. Not looking for the quick fix, just looking to better understand what's price doing right now And because of what it's doing, where do I think it's going next? I promise that you're still not going to get it right because I don't get it right. I lose as much as anybody else does, but I manage my losses. I try to capitalize my winners, and then I just try to do better the next time. Take pictures of what I did, study it to see what I can improve, point out my mistakes so that I can try not to make that mistake again. And then I just try to be better. Education will get you further than paper. And if you want to test something, use the hard right edge. So you find an example of yesterday's low or today's low being checked, like I just highlighted right here. Find that in a previous day and study it in excruciating detail. Take pictures of it. Did it work after it bounced? Did it not work after it bounced? You'll learn more from going in the past and finding 500 examples of this than you will from sitting there trying to trade it as it plays out in real time in front of you. I guarantee you will learn more from going into the past and studying it than sitting here for 4 hours trying to trade it. That worked for me. But the really great thing about trading is we can all do it our own way. So if you find what works for you, do that. But this is what worked for me. And I'm a nerd. So I'm always going to lean into education. But you've been around, Marziti. You've seen the new guys come in, right? And it's that cycle. Hey, what do I do? I need a strategy. So we throw them a couple strategies, right? And they say, "Oh, I can do that. That's an obvious. That's obvious. I can do that."
Yep.
there's a lot of people out there who can do the rote trade. It's popular, right? They are the buy the dippers, and their discords are all over. All they do is buy calls and run it up. They just buy the dip, buy the dip, buy the dip every day. And as long as we're in a normal market, those places they tend to do pretty good. And if you ask them anything about trading, there might be one guy in there that knows. The rest of them, they're just monkey see, monkey do. And they just buy the dip. And because he's confident, they're confident and they run it and it works good. And that works in a great market, a general market, a typical market. So you can be that mechanical rote trader and do pretty good just on confidence alone. As long as nobody dents your confidence and you stay mechanical, you can handle it. It it'll fly. But when we get a different market, like we're in now, this confusing, broken, difficult market, those places they don't do well. They tend to lose a lot of members, and the the ones that don't leave, they just kind of hang out and wait, and then it'll pick back up again. So if you want to be mechanical and just take that same trade, that one that I was highlighting on Thinkorswim, where we came down and we tagged the level and it was just like a very mechanical trade. You can do those and you can set alerts for these, right? It's not like it was a surprise. We knew when price began falling that it had the potential to go to the low of day. So even way up here, we knew it could go down there. So we could ask the question an hour in advance. Hey, what if we go to the low of day today? What do you think? You could spend the next hour answering that question. So, but by the time price got there, you had a pretty good idea of whether or not you should buy it. That's generally what I do, right? That's the kind of trades that I like to take. And I don't have much on my plate. So I'm here all day, baby. If it doesn't get there, so what? If it does get there, yeah, I might trade it. So I'm really patient and I've got all day. Look at your job, look at your life. You know, if you don't have the time, set an alert. Maybe you get an alert, maybe you don't, right? But at least you get the opportunity to trade. And if you can't do that, then what are you left with, right? You're left with trying to trade inside of some zone or range, something that looks a little bit like that, and you're trying to figure out what am I supposed to do? Like go long, go short? Is that a signal? Was that a signal? I don't know. What are we doing? That didn't work too good. So time of day, what kind of day? What are we supposed to do today? Go sideways, go long, go short. This was supposed to be a sideways day, kind of hold the line into the close, I believe is what I said in the morning briefing. I showed the breakout levels. If we was to break out, I gave levels of where we would likely go. But otherwise, today we were just supposed to hold the line, kind of hang out and wait for the week to end. I kind of feel like that's what we did. So what would I know on a day like that? I don't want to buy calls. I don't want to buy puts. Buying says I think price is going to go somewhere. If it's supposed to be a sideways day and we're not supposed to go anywhere, then buying calls and puts doesn't seem like a good idea. To be fair, we did go somewhere, right? We got up and went, but that wasn't the base case, and we wiped it all out already. We gave it all back. In the morning briefing, I talked about the ADRs today. Made an explicit point to point out if we're going to do today what we generally do every day, we're going to just hang out inside these two red lines because that's what we've been doing. And today wasn't supposed to be bullish or bearish. So if we're not bullish, we shouldn't get up here. And if we're not bearish, we shouldn't get down here. But we very likely can just hang out either inside of our Globex or between the ADR high and the Globex low. And that's what we did today. So if that price action doesn't suit your needs, today's very likely not going to give you the trades that you want. You don't even bother to sit here and trade it, paper or otherwise. Go learn something instead. You'll get more out of your day. And if it did turn out to be something because it did something we didn't expect, so what? You didn't miss anything. It was a random one-off and we didn't see it coming. So you probably wouldn't have traded it. You didn't miss a thing. focus on education, not trying to paper trade. You will grow faster personally, right? You'll internalize how to trade faster if you just leave the paper trading alone and focus on education. By the way, there is a nano product. I think it's called BIT. It's one of the smallest products you can trade in the futures. It risks 5 pennies. Now, this isn't options where I say 5 pennies and it's really $5. This is literally 5 pennies, right? So if I was to take a trade here, every tick that you see this thing moving, that's 5 pennies. Now, I don't want to lose anything, right? I don't care if it's 50 cents. I don't want to lose anything. This is Bitcoin, by the way. It's just a nano Bitcoin product. So if I wanted to trade live but keep my risk down, I could come in and trade this if that's what I wanted to do, right? That way I'm at least trading live and I'm keeping my risk small. Now, to be fair, I've seen Jeremy make, what was it, like $50 or $100 trading this thing. So you can make money with it. But it would get you live and keep your risk down. And that way you at least get the adrenaline and all that, your emotions are in there because Marziti's right about that. You're going to feel it. You think you're ready until you do it, and then you learn. The the symbol is BIT, and I'm on the K because, like, futures use letters to tell you what contract series you're in. So this is the BITK series, and 6 is for the year 2026. So there's a BIT. If you don't see a lot of liquidity on this, you can add it to your watch list column. If you don't see a lot of liquidity on the BITK, then add the next letter. So BIT. Hey, I'm typing here. Let me in. BITK and then BITM. And then you can compare those two and look at which one's got more volume. And you want to trade the one that has the more volume, right? So here's K up here. I'll just move it down here so it's next to it. Hey, get down there. BITK versus BITM. Their total volume, 90,000 versus 343. So K is the one that you want, right? BITK 6. It won't show up on Thinkorswim, so don't even bother. But it's very low risk. And if Jeremy can win 100, that means you can lose 100. So you can lose money on this if you get the trade on and then you forget and leave it on. Don't do that. Make sure you're out. Make sure you clear all your stops and all your orders off the dome because this thing can run. I know that might sound like some pretty obvious stuff, but I'll tell you, one day I woke up and I came in the office and I was down like half my account. Half my account was gone. I don't know if you guys have ever heard that story, but it sucked. And what happened is I left an order on the dome, and the NASDAQ, that damn thing can run. I had an order on the dome, but we had run so far away from it that I didn't see the order anymore. I was done trading for the day, so I called it quits, shut everything down, and I left that order on. It filled in the middle of the night. By the time I came in the office, my account was cut in half. Talk about feeling like an idiot, right? That was my own fault. Nobody to blame but me. And I did that. I had to work to get my money back. So just make sure you clear all your orders before you're done for the day. Don't leave anything on there. Yeah, that was not a lot of fun. The NASDAQ, by the way, is the most liquid. The MNQ, it is more liquid than the ES and the NASDAQ NQ. See the volume, 161,000 versus or 1,610,000 versus 452, or 1,007,000 or 1,021,000. Right, that 1,600,000 on the MNQ, it is the most liquid out of all of those. You wouldn't know it by looking at the dome, but it is. That sucker can move, yeah. Which is why you want to work on like trade drills with this thing, because it offers you opportunities to run drills. Earlier, I took that trade on just a pullback drill that I've done over the years. The Nasdaq will make a run up and then fall some more, or it'll make a leg down and then run up. So because we know it moves a lot, if you want to go up, wait for a red candle, right? And this is just drills. You don't get hurt. All you're waiting for is a red bar, and then you jump onto it. If it doesn't work, you got like a 3-tick stop or a 4-tick stop. It's in paper. You don't care. You do it again, and you do it again, and you do it again. And you get better at trying to time how big of a pullback do you need? How big of an opposite candle color do you need before you hop on that in the drill? And that's all it is, right? It's not a trade strategy. It's just a drill. It's to help you with the order flow and reading the tape and reading price fast. This is a 100 tick chart. It's fast. You can do all kinds of things with trade drills. Work on your entries, your exits, add-ins. There's a swing trade, not a swing trade, a swing pivot price pattern, right? This is a swing high. That's a swing low. That's a swing high. That's a swing low. Well, the thing is, after you get a good swing low like this, you're supposed to have wicks underneath those bullish bars. So if you know there's supposed to be a wick underneath that bullish bar and you're trying to run it to the upside and you just get a swing low, you could wait for the current bar to close and the new bar to open and the wick to form, and then you buy it on the pullback. This is the continuous contract. I can't trade that. I need this one. Right? So just drills, just different kind of drills. That one that I set up back here, I don't know, it took a little bit of heat, not very much, or it would have stopped itself out. What is that? 41, call it 41 and a tick. The low was 38 and a half. Something like that. Just paper junk. You could do a lot of funny things in paper junk. But if you don't have a strategy, don't worry about it. Focus on price action, trying to better understand different price patterns, and then getting those patterns to show up at a specific point on the chart. The obvious ones are, you know, today's low, yesterday's high. They're easy, they're simple. I use a yesterday's 111 and a yesterday's 1236 when we get them. We don't get them all the other time. But when you got something like that, what a beautiful setup, right? I mean, that's fantastic. It's kind of late in the day, and that sucks, but it's a really nice bar. Could have used a longer wick, and it's a really good candle pattern. I love this setup. That was a gift. If anybody was watching it, looking for it to show up, you could have seen it coming because you know in advance we're heading down. We might get there, we might not, but you know we're heading in that direction. And then what a beautiful candle pattern. There's your trade. Now, you might go 2 weeks before you get another one of those, which is why I argued if you were trying to learn that by paper trading it, you would waste 2 weeks before you get another one. And what's the chances that you're actually sitting there ready to trade it when it shows up in 2 weeks? Well, don't do that, right? Do something else. But I bet you can go back and find 50 examples of that somewhere in the past, and you can study it, put it on different time frames, look at the price action, check the news, what time of day, everything that you can do to try to trade that better. And that's just one reversal. The cool thing is this reversal on this low would work the same way if that was yesterday's low or the ADR line, right? Or the VWAP or whatever it hit and turned around, that pattern would work no matter what you hit because it's that setup. It's by reading that price pattern. I posted in the chat about Secrets of a Pivot Boss. I really wish I had read that book when I was newer to trading because on my own, I figured out that our days repeat and that it's just these same days over and over and over again. But I got there on my own from doing all this extra work. And it took a lot of time. And I felt like a genius when I first figured it out. And then I found that book and I'm like, I'm an idiot. I could have just read that book and I'd have been good. I'd have been done. I'm a bit of a speed reader. I'd have been done in 3 days. But no, I spent months figuring it all out, charting it, marking it, absorbing it. So these different days, sometimes we can tell even before the 9:30 bell what kind of day we're going to have. Not 100%, but man, when you can and you got high conviction that today's supposed to be sideways even before the bell rings or that today's going to be a breakout day and we're going somewhere, you can really monetize that stuff. Yeah. So it doesn't matter that you can do it every day. It just matters that sometimes you can call that crap in advance. And when you can't, well, it's okay. You just sit back. Don't guess. Just leave it alone. Because if you don't have it, you don't have it. It doesn't matter. When we rolled over today, I wasn't happy with the rollover. It took a little longer than I would have liked. Um, I think I had two trades up here that didn't work. Small stops. I had one trade that was basically a break even, or maybe I got a tick out of it. I still call that a loss. And then I finally got the trade that worked its way down. Like, yay, fine. I wasn't overly excited about it because it wasn't this really beautiful reversal that we had back here, right? It was more of this kind of stupid little grindy grind higher, and then it finally went. I don't care. I'm not in it for the win rate. I made some really good money on that drop today. The fact that I had 3 or 4 losses in front of it, I don't care. I made way more money today than I lost. So I'm not worried about win versus losses, right? My win rate is less than 70. If I look at my day, my week, my month, my quarter, my year, it's all less than 70. No, I think that's the best book. There is the one called, was it, oh, Marziti, help me out. What's that day trading book that everybody loves? Um, yes, Hit and Run. There is that one, but it's the strategies are good. You just can't use the exact size that they tell you, right? Because they'll tell you like, okay, that setup is a short, and so tomorrow you want to put your stop, like 3 pennies higher, but don't do that part, right? Leave that alone. But they do give you some really good insight into some trade strategies in that book, and it ties in with a website that I've shown before called Swing Trade Bot. So somebody read that book and coded those strategies into scanners, and you can get them on this website. I'm going to bring it up. The website looks kind of janky. I remember when I first got here, I was like, "Oh no, this doesn't look like a really good website." But don't let it fool you. There's nothing wrong with this site. Notice I'm not logged in. You don't need an account to do end of day scans, and you can after you read the book, you can come to this website and you can run scans and it doesn't cost you anything, right? So end of day scans, we want that. And we can scan by type. And here's the different types. Or we can scan all scans. And of course, these names won't make a lot of sense if you haven't read the book yet. Come on. Oh, it's still working. But the scans have names. So the 180 bearish, the boomer sell signal, death cross, whatever it is. They got like Gilligan's Island and some other weird names. Once you've read the book, you'll know what that means. And then you can run the scan and see what the results are. I'm picky about liquidity. So, a lot of the names that it finds, I'm like, yeah, I don't want to trade those, So it kind of helps if you have an account so that you can be more specific about the names that it finds. But for a free scan, it's pretty darn good. And here's the rules for whatever I picked, 180 bearish. It has all your rules there, and it tells you where the rules came from the first book that was published or the second book, because there is a part one and there is a part two. No, I think if you Google hit and run trading, there's only one author. There shouldn't be a lot of replicas out there. Plus, I've shared it in the chat. So here it is. Hit and run trading the short-term stock traders Bible by Wiley Trading. Jeff Cooper right there. Yep. That one has, I mean, the strategies are really good, right? Because what I liked about the book is it explained how he came up with the strategy. It isn't just like, okay, look for this signal and put your stop here, because that doesn't teach us anything, right? Instead, the book's like, I had this great idea and I kept seeing this one thing happen. So I dug into it, and this is the research behind it, and this is the psychology of why people are buying or selling. And so I built this strategy to do this. And I really liked that approach. It gave you a bit of a story, so it wasn't so boring to read, and you kind of feel like you're you're learning something. I don't know. I don't know a better way to say it. It it was a good read, and it was educational too. Some of those books can get so freaking boring. The Art and Science of Technical Analysis by Adam Grimes, really old book, but I really like that one. That's another book that really mimics my approach to trading. Unfortunately, I read it after I did all the damn work on my own. I could have saved myself a lot of time if I'd have read that book first. But it's an old book, and I'm pretty sure that there's probably a better book out there. I just don't know what it is. Because once I learned it, that there was a guy out there who was already doing the same thing that I do, I just kind of stopped there. Like I didn't try to find more books that say the same thing that I'm saying. But it's Adam Grimes, The Art and Science of Technical Analysis. Now, with these book ideas, I'll give you guys something that I did with a book, and I do this with books. This is something I really like doing. So, say I get my hands on a new book. I'm a bit of a hands-on type of a person. So, I create a Discord, and I name the Discord the name of the book, and then I rip that book apart chapter by chapter, and I put it into the Discord. Now that's me. Some people might say that that's a lot of work. They don't want to do it. That's fine. You do what works for you. Here's the art and science of technical analysis. Every chapter broke down, and I added to the chapters over the years. Not here, but I got another Discord. I added to the chapters. I found examples of what they talked about in the book. If there was things I didn't understand, I went to YouTube, and now AI. But back then, YouTube, I went to the web. I hunted for explanations to the stuff that I didn't understand. I found examples of the stuff in modern charts on my broker, and I just literally ripped that book apart because I wanted to really absorb and understand what I was reading in the book. It's easy for me to just speed read. I'm a very fast reader, but for anybody who speed reads, you kind of blur some stuff. And I didn't want to blur any of this. So I went through it in detail. But I remember what I went through. I do have a hit and run Discord. Yes, but it's my Discord and it's not public. Just like this one is not public. So what I recommend is make your own Discord, right? Call it what you want and then cut the book apart into pieces, migrate it into that Discord and grow with it as you are learning it and as you're reading it. I've got candle discords, options discords, like Tasty Trade. I went to their YouTube and hijacked every video I could find and organized them into a Discord, started watching them, taking notes, screenshots, writing down things that I needed to research. And when I'm studying, I turn off everything else. I might have soft music in the background, but like no TV. I'm not messing with my broker, no multitasking. I'm sitting there, I'm watching it, taking notes, pausing, taking screenshots. I'm all my attention is on that thing because I know me. If I get to screwing around with my broker, drawing lines, looking at charts and price, chatting on the Discord, and thinking, "Oh yeah, I'm watching the video. I'm watching." No, I'm not. I'll miss half of what I'm supposed to be paying attention to. You can do the same thing with websites like Investors Business Daily. They have a lot of really good swing trade stuff by William O'Neill, right? He's like their big dog over there. At most of IBD stuff is based on William O'Neill. And every year they offer a free or nearly free access to Investors Business Daily, and you get access to everything. So I went over, signed up, got a hold of all of their educational stuff, and just downloaded everything I could get my hands on, and built a Discord based on IBD material. Right. So same thing I did with stockcharts.com, other places. Gather information and then sort it out later. An entire Discord on range and trend. Literally. I wish I was making that up. Oh, yesterday we were talking about the half day wedge. Yesterday's price, the half day wedge. There's another one, half day wedge. All of these are half day wedges from the same day, actually. They were just different markets. Like this one is the advancing and declining issues. That's the NASDAQ 100. That's the S&P. But that half day wedge breakout, I love that trade. Haven't seen one in quite a while, be fair. Still can't find that video, but whatever. I'll find it sooner or later. That's the problem with having all these discords. Too much information. So for me, this kind of work is way more valuable than trying to paper trade. But that's me, right? And everybody should do what works for them. Before we wrap up today, I wanted to talk a little bit about managing risk. I found that a lot of people are really struggling with this, and especially new traders when they think that winning is more important because it's less complicated. Everybody understand the whole risk to reward idea, right? In theory, in practice, you can do it. You understand why you want to do it, right? You work towards getting that done every time you take a trade. Or and if you're not, then you are understanding why it it's not a good idea, because like credit spreads, the typical credit spread has a really bad risk to reward, and we're supposed to accept that as okay. I mean, that's what everybody says. So there's times where it don't fit. The Nasdaq is one of those charts that on the intraday has uh, an absolutely amazing risk to reward if you take advantage of it. I was screwing around this afternoon here on paper with a 4 tick stop. And so what? It's paper, you know what I mean? Like we're not going to get hurt. But I can do the same thing all day long, just playing around, playing around, playing around. Put a 3 tick stop on or a 4 tick stop and try to trade it. Who cares if you lose 5 times? What do you lose? 1 point? That's $2. Lose 10 times. So what? Get one winner and get a $40 price move, right? You'll pay off all those losses and you got your profit. Now, I'm not encouraging you to do that as a trade strategy, right? But if you want to go to paper and try something, try that. Put the chart on something small so that you get a lot of occurrences. You want these legs in price, right? There was a leg, there was a leg, there's a leg, there's a bit of a chop, there's a leg, some chop, there's a leg, right? You want those legs. So if you're getting legs frequently, then you have an opportunity to trade. If you're on, say, a 5-minute chart and you're dealing with this, your opportunities are a lot more limited, right? So give yourself a time frame that is actually moving so that you get a lot of occurrences. Go into paper and try a really tight risk to reward program. Do it on the Nasdaq, not the ES, because the ES or the MES, it doesn't have as many leg frequencies with the size that we want, right? It has the legs. It just they don't go as far. So instead of getting a risk 1 to make 20, like you get on the Nasdaq, you'll get a risk 1 to make 4 or risk 1 to make 5, like you do on the ES or the MES. It's a really good way to help you get past that whole idea of wanting to win all the time. Um, my less than 70% win rate is not based on just doing a bunch of silly stuff like I was doing here. It's more mechanical than that, but it's still run with a really good risk to reward. If I give up my risk to reward, I can get a higher win rate. I've proven that. I can get into the high 80s, sometimes the low 90s, but my I have to give up on the reward side, right? The the tick setting will change depending on what type of day you're having and when in that day you're doing it. So I'm on 500 right now, but if we was doing this at 9:30 in the morning, maybe I would need 1,000, right? If I was doing it at lunchtime, I might need 250 or 300. You'll know it's the right setting because you'll have an opportunity to do the strategy, right? Or do the drills. If it's too low, you don't have any opportunities because it's all going to look like a bunch of wicks. And if it's too high, you won't have any opportunities because they'll all look like 15-minute candles. So if I set this on 100 and we look at it, it's getting a bit wicky to me. I guess 100 would work if you wanted to do it. But if you go too low, you'll just get a bunch of weird looking wicks and a bunch of dashes and these white little dojis everywhere. And if it's too big, it'll look like a 15-minute candle. So put it on a number that gives you opportunities to get these legs. See, like that leg right there or that little leg there. If you don't have any of those, then what are you doing? Right? Like what's the whole point? Because you're not trying to trade a reversal, a setup, a crossover. You're not waiting for a strategy. You're just doing a trading drill, like standing on the keys and throwing from the free throw line in basketball. It won't make you a better basketball player, but it will work on your free throw shot. This is just to help you with your risk reward logic, help you with the math, getting you more comfortable with the theory. You just don't actually trade this way, though. And your risk to reward is directly connected to your win rate. That's important to understand because your losses will increase if you're going for a higher risk reward. Do I use ATM? I don't know what you're asking there. But I know that I've read a lot of books and I've read a lot of blog posts that talk about risk to reward. And it seems like none of them mention that if you go from a risk one to make one or a risk one to make two, and you try to go for a three, four, five, you will lose more frequently, right? Like that's the way it works. There's not really a whole lot you can do about it. So you have to be willing to accept that, hey, I'm going to have more losses because I'm trying to use a greater risk to reward. Yeah, yeah, you can use the buttons, you can use the dome, you can use the chart with these buttons, whatever works for you, right? Whatever it is that you want to do. It's the whole idea that you're going to use a really tight stop. Now, for me, a tight stop for the NASDAQ in the middle of the day is 3 ticks or 4 ticks. I've talked to people who started this out and their quote tight stop was 5 points, 8 points, 10 points. So you do you, right? 3 or 4 ticks is tight to me. And if you're doing it on the ES or the MES, which I don't really advise, but if you are, then 2 ticks, right? Something very tight because you don't want to give it any room. All you're trying to do here is force an opportunity for you to capture one of those legs. And if you're wrong, you're just immediately going to get stopped out, like immediately. But the goal behind it is to get you to think about the risk to reward and not focus on, oh, I took 10 losses before I finally got this to move because this isn't your strategy, anyways. That's not even the point. I literally today had this high that I shorted, right? And I had, I don't know, 3 or 4 losses up here before I finally caught that move to the downside. I don't care, right? Because my risk to reward was really good. It was frustrating, but that was me jumping the gun and I had too much going on. I should have just tuned everybody out and focused on it. But instead, I jumped and I had my 3 or 4 losses. They were really small. I think one was actually on the positive side, paid commissions, but to me, it was still a loss. Nah, no need. Yeah, everybody take it easy. If you got topics that you want to hit, let me know. Let Kevin know. We're always interested in new topics to cover. Um, and if you have trades that you want to review, charts that you want to look at, if you want to talk about a particular market or idea, whatever you got, let us know. We'll get something put together. I hope you all have a good weekend. Let's get back at it Monday.